Hello friends, and welcome back to our community. It is wonderful to have you with us again today. If you have been watching the news lately, you might believe that our economy is bulletproof and that everything is business as usual. However, there's a massive, untold story unfolding right beneath our feet, and it directly impacts your financial future. We are calling this the story of the hidden buyer. Specifically, we need to understand exactly how the United States quietly absorbed China's $688 billion exit from our market. This is not just about dry financial numbers. This is about a fundamental shift in who owns America's debt. We are witnessing a quiet maneuvering where the second largest creditor in the world walked away and the market barely blinked. How did that happen? Who stepped in to buy nearly $700 billion worth of bonds? The answer might surprise you, and it reveals a hidden fragility in the system that everyone needs to be aware of. If you have been following the financial headlines for the last 12 months, you have witnessed one of the most sophisticated narrative management campaigns in modern economic history. The story sold to the public was one of resilience. We were told that the American economy was a juggernaut, that the demand for American debt was organic, and that the geopolitical tensions with the East were manageable risks. I want to pause here and ask you a question. Does this resilience match what you're seeing in your local town or at the grocery store? Let me know in the comments below. Type real if you think the economy is strong, or fake if you think the numbers are being manipulated. I read every comment because your boots on the ground perspective matters more to me than the official reports. But if you look at the raw ledger data, specifically the Treasury International Capital reports released this week, you see a reality that challenges that official story. We are not witnessing a market that is purely resilient. We are witnessing a market that appears to be supported by non-economic actors to offset a massive structural exit by its second largest creditor. Now, before we go further, one clarification matters immensely. The data we are looking at tracks custody. It shows where securities are held, not necessarily why they are held, and not who ultimately bears the economic risk. This distinction is critical because it explains how large shifts in ownership can occur without us seeing immediate price changes on the screen. In our previous discussions, we established the liquidation signal. We demonstrated using forensic data that China has strategically, methodically, and aggressively dumped massive amounts of United States Treasury bonds. This appears to be more than just a simple rebalancing of their checkbook. The scale suggests a coordinated exit designed to clean up their balance sheet for potential future conflicts. They sold these bonds to evade the kind of sanctions that froze Russia's assets in 2022. And instead, they bought hard assets like gold, oil, and strategic metals. But that investigation left one massive critical question unanswered. It is the question that many bond traders on Wall Street have been analyzing in private notes, but rarely address on live television. If the second largest creditor in the world dumped hundreds of billions of dollars of debt, why didn't the market crash? Let us look at the basic dynamics of supply and demand. The United States Treasury market is the deepest, most liquid market on earth, but it is not immune to volume shocks. When a massive seller floods the market with supply, prices typically succumb to downward pressure. When bond prices fall, yields and interest rates rise. If market forces were functioning without intervention, the exit of a player the size of China could have been a destabilizing event. Models suggest we might have seen the 10-year Treasury yield breach 6% or 7% during this liquidation window. Without the intervention of the proxies and the shadow network, the outcome would have been catastrophic. We could have seen mortgage rates spike into double digits, putting immense pressure on the American housing market. We might have seen stress metrics flash red across the regional banking system, which is already managing hundreds of billions in unrealized losses. Historically, comparable foreign selling events produced far sharper reactions. During Japan's reserve drawdowns in the late 1990s, Treasury yields moved violently. During China's 2015 reserve liquidation, yields spiked despite accommodation from the Federal Reserve. In March of 2020, even modest selling pressure caused Treasury market dysfunction. By comparison, the relative calm during a $600 billion liquidation stands out as an absolute anomaly. But that worst-case scenario did not materialize. The yields rose, yes, and they have been stubbornly high. But they did not break. The auctions were sloppy, and the tail was long, but the primary dealers absorbed the supply. The crisis was averted. The volatility was contained. Why? How did the United States Treasury market absorb a $600 billion selling wave without triggering a systemic event? The data suggests they did not rely solely on the free market. A purely commercial market would likely have demanded a higher liquidity premium. Instead, the data indicates that a shadow network of proxy buyers stepped in to act as the backstop, the bid of last resort. We need to advance our investigation from the seller, China, to the buyer. When we look at the flow of funds data, the buyer profile shifts dramatically. The debt that China dumped did not appear to go to mom-and-pop investors. It did not go to regional banks who are currently constrained on capital. It did not even go to the Federal Reserve directly, as they are ostensibly maintaining quantitative tightening. So where did the bonds go? The flows point to two specific non-economic actors: the geopolitical proxies, meaning our allies, and the leveraged speculators, essentially the mercenary creditors. This appears to be a coordinated absorption operation. The financial system effectively swapped a hostile creditor, China, for captive creditors, the allies, and tactical creditors, the hedge funds. This kept the yields from exploding, but it has drastically altered the risk profile of the global financial system. We have moved from a market underpinned by global trade surpluses and stable long-term money from nations that sell real goods to a market underpinned by geopolitical alignment and leverage, which is unstable short-term money. The debt has not disappeared. It has not been paid off. It has simply moved from strong hands, hands that held it for 30 years, to weak hands, hands that may fold at the first sign of volatility. To verify this, we look at the latest data from late 2025. The numbers are stark. China's holdings have hit a new low of $688 billion. This is down from a peak of over $1.3 trillion. That is a liquidation of roughly $600 billion. That is more than the entire gross domestic product of Sweden or Poland pulled out of the United States financing structure. This capital had to come from somewhere. Counterparties had to write the checks to provide China's exit liquidity. In our last discussion, we identified the United Kingdom and Belgium as key players in this absorption. We noted their holdings spiked as China's fell, but identifying them is only the first step. Today, we need to analyze the mechanism of that buy. It is not enough to observe the United Kingdom bought it. We have to ask, with what capital? Because if you look at the fiscal realities of these nations, the math requires explanation. The United Kingdom is managing a twin deficit environment. They have a budget deficit and a trade deficit. This means the British government typically does not have a national savings account overflowing with excess dollars to recycle into American debt. Unlike China in the 2000s, which was earning billions of dollars a month selling manufactured goods, the United Kingdom is a net debtor in this context. This fiscal reality leads us directly to the true owners and the leverage trap. So, when the reports show the United Kingdom holding nearly $878 billion in United States Treasuries, surpassing China to become the number 2 foreign holder of American debt, we have to ask, who is the actual buyer? It is not purely the British government. The United Kingdom line item in the data is largely a proxy for the City of London. London is the hub of the Eurodollar system, the offshore banking network where United States dollars are created, lent, and traded. The surge in United Kingdom holdings likely represents a massive mobilization of Western banking capital. It suggests that transatlantic banking giants may have acted as market makers to absorb the supply coming out of Asia. Then we look at Belgium. Belgium's recorded holdings sit at nearly $470 billion. Let us pause and consider the scale. Belgium has a gross domestic product of roughly $600 billion. It is structurally unlikely for the Belgian government to hold nearly 80% of its GDP in United States Treasuries as a sovereign reserve. So why is Belgium showing these inflows? Because Belgium is the home of Euroclear. Euroclear is one of the world's largest international central securities depositories. It is the plumbing where securities are held in custody for third parties. When you see Belgium buying in the report, it is rarely the Belgian state. It is a custodial mask. Market analysts suggest that official sovereign wealth funds from allied neutral nations may be routing purchases through Euroclear to maintain anonymity. But here is the risk in this arrangement. These proxy buyers may not be price insensitive. China bought United States debt because they required it to peg their currency and recycle a surplus. They held it for decades. They were a sticky buyer. The banks and proxies are buying it potentially as a policy response or a short-term store of collateral. They are renters of the debt, not necessarily owners. If their economies face headwinds, these entities may be compelled to sell. And because they now hold nearly $1.3 trillion combined, their potential selling could be more volatile than China's. Does hearing about these proxy buyers make you feel more secure? Or does it make you worry about the stability of the dollar? I would love to hear your thoughts. Please share your opinion in the comments below, because this shift from ownership to renting the debt is something very few people are talking about. But the proxies are only half the story. The other half of China's debt did not go to a government. It went to a jurisdiction known for opacity. And this is where the real systemic risk lies. If you scan further down the report, past China, past Japan, past the United Kingdom, you will find a line item that demands scrutiny: the Cayman Islands. This jurisdiction is now listed as holding over $418 billion in United States Treasury debt. Obviously, the local island economy is not buying $500 billion of government bonds. This is hedge fund capital, and specifically, this is the footprint of one of the most leveraged trades in modern finance, known as the Treasury basis trade. But here is the critical detail. The official number, $418 billion, is likely an undercount. Research from the Federal Reserve suggests that the actual exposure of Cayman domiciled hedge funds is closer to $1.85 trillion. Here is how the hidden buyer likely absorbed China's exit. It is all about the spread. When massive supply hits the market, the price of the cash bond falls slightly below the price of the Treasury future. Hedge funds step in. They buy the cheap cash bond, the supply China is shedding, and simultaneously sell the expensive future. They lock in the difference. Because the profit on this trade is tiny, they use significant leverage. They take the bond, pledge it as collateral in the overnight lending market, and borrow cash to buy another bond. They repeat this cycle. Industry estimates suggest leverage ratios can reach 50 to 1 in extreme cases. Do you see the structural transformation? China held the debt with cash. They owned it. It was a 1-to-1 position. The hedge funds hold the debt with leverage. They own it with borrowed money. It is a sensitive position. As long as they can borrow cheap cash overnight, the trade works. But what happens if interest rates spike? The hedge funds face a margin call. And unlike a sovereign nation that sells over years, leveraged funds must sell immediately. With the risks clearly defined, we must now discuss the protocol and final advice. We have identified the buyers. The mystery of the China gap appears solved. It was not magic. It was not purely organic demand. The data indicates it was filled by political proxies like the United Kingdom and Belgium, and leveraged speculators hiding in the Cayman Islands. The conclusion is defensible. The quality of the United States creditor base has shifted. We have moved from strong hands, sovereign nations with trade surpluses, to weak hands, leveraged speculators and proxy states. Weak hands are more likely to exit when volatility rises. This means the next Treasury market correction could be faster and deeper than historical norms. The structural buffers are thinner now. So how do you position yourself against a system held together by leverage? How do you protect your wealth when the mercenary creditors potentially rush for the exits? You need to follow a strict protocol. Rule number 1 is to avoid the blast radius of the basis trade. This trade has historically unwound during periods of high volatility. When it unwinds, liquidity often evaporates. Do not rely on being able to sell assets easily during a crash. You must maintain a liquidity buffer. Keep a significant portion of your portfolio in cash equivalents. Specifically, short-term Treasury bills with a 1-month to 3-month duration are ideal. Crucially, hold these directly via Treasury Direct or a brokerage account, not in a bond fund that might block withdrawals during a panic. You want the asset that is the collateral itself, not a claim on a fund that holds the collateral. Cash is your oxygen mask. When the trade breaks, institutions scramble for cash. You want to already have it in your hand. Direct ownership avoids the layers of structural exposure that could trap your money. Rule number 2 is to watch the interest rates carefully. You need a warning system. The canary in the coal mine for this entire structure is the secured overnight financing rate. This is the interest rate that hedge funds pay to borrow cash overnight. Normally, it tracks the Federal Reserve's target rate closely. But if you see this rate spike significantly above the Fed funds rate, even by just 0.05% or 0.10%, it indicates stress in the plumbing. It means the banks are restricting lending to the hedge funds. It means the leverage is becoming expensive. That is your signal. The moment you see stress in that overnight market, you must move to safety. Exit risk assets immediately. We observed this in September of 2019 and again in March of 2020. History offers us a template, and we would be wise to use it. Finally, rule number 3 is the gold hedge. Let us look at the trade one last time. China sold bonds and bought gold. Hedge funds borrowed cash and bought bonds. China is holding the asset, which is metal. The hedge funds are holding the liability, which is paper wrapped in more debt. In a diverging event, paper assets face pressure while hard assets tend to outperform. You should align your long-term savings with the entity that is buying the hard asset, the sovereign nation, not the entity that is gambling on the spread. Accumulate physical gold. When the basis trade unwinds, central banks are often compelled to intervene with liquidity. That liquidity injection can devalue the currency and send gold higher. Gold is the only asset that has no counterparty leverage risk. It is the only asset that does not depend on the overnight lending market to function. Let the hedge funds pick up the pennies in front of the steamroller. You stand on the sidewalk with the gold. Now, we must consider the final endgame scenario and what it means for your retirement. Because here is the hard truth that very few people are willing to speak out loud. We have talked about the proxies, and we have talked about the hedge funds, but what happens if they stop buying? What happens if the United Kingdom faces its own crisis and needs its cash back? What happens if the hedge funds in the Cayman Islands blow up because volatility gets too high? Who is left to buy the debt then? When the hidden buyers vanish, there's only one entity left in the room with a checkbook large enough to save the system. That entity is the Federal Reserve. We are moving toward a future where the central bank becomes the buyer of last resort, not just for a crisis month, but permanently. Economists have a technical term for this. They call it yield curve control. It sounds boring, but for those of us on fixed incomes, it is the most dangerous phrase in the English language. Yield curve control basically means the Federal Reserve prints money to buy government bonds specifically to keep interest rates from rising. They did this back in the 1940s to pay for World War II. It keeps the government solvent, but it destroys the saver. Think about what this means for you. If inflation is running at 5% or 6% because of all the new money printing, but the bank is only paying you 3% on your savings because the Fed is suppressing the rates, you are losing money every single day. You are safely losing your purchasing power. This is what we call financial repression. It is a hidden tax on everyone who did the right thing, everyone who saved their money, and everyone who relied on a pension. The number on your check might stay the same, but the amount of groceries you can put in your cart will shrink. Is this shrinking purchasing power something you're experiencing in your own household budget? I know many of you are on fixed incomes. Tell me in the comments, what is the one item you have noticed has gone up the most in price lately? It is important we share these real-world examples. This is why understanding the hidden buyer is so critical. It is not just about some bankers in London or Brussels. It is about the transition from a free market to a managed market where your savings are the fuel that keeps the engine running. The shift from strong hands to weak hands eventually leads to the iron hand of the central bank. When that happens, the rules of retirement planning change completely. You cannot just sit in a traditional 60-40 portfolio and hope for the best. You have to be active. You have to own real things. You have to be debt-free so you're not at the mercy of their rate resets. The system is designed to protect the institutions, not the individuals. The proxies and the leverage traders, they will get bailed out. The average saver usually gets left with a bill in the form of higher prices at the gas pump and the grocery store. So, as we close this dossier, I want you to take a hard look at where your security truly lies. Does it lie in a promise from a government that is borrowing money from hedge funds to pay its bills? Or does it lie in tangible assets, in your own lack of debt, and in the resilience of your local community? The hidden buyer has bought the system some time, perhaps another year, perhaps two, but they have not bought a solution. They have just rented a little more stability at the cost of much higher fragility down the road. Use this time wisely. Do not get complacent just because the stock market is green today. Look at the plumbing. Look at the flow of funds. And most importantly, look out for each other. We are navigating uncharted waters, but we are doing it together. Stay vigilant, stay skeptical, and keep your powder dry. Be careful out there, friends.